Good afternoon, everyone, and thank you for joining us. My name is Michael Browne. I'm the head of Commodities at Barchart, and I'm joined today by Darin Newsom, president at Darin Newsom Analysis. So I think we've got a great webinar for you today. Darin is going to give us an update on the grain markets, and it's certainly good timing on that. This markets have been pretty crazy here the last several months. We've got an acreage report coming out at the end of June. We'll have a chance at the end to kind of preview, what's happening there. And then when Darin's done, I'm going to spend just a few minutes talking about our enterprise solutions for ag at Barchart, and then we'll open it up for questions and answers. So with that, I'm going to turn it over to Darin and let him share his thoughts on the current markets. Darin?
Thank you, Michael. And as Michael said, appreciate everyone joining us here this afternoon. I'm going to be focusing on predominantly, I'm going to be talking about the corn and soybean markets, but there's going to be plenty of time at the end. If you have questions about anything else, any other markets, anything that I don't touch on as we quickly go through these markets. So Michael, if you could go ahead and hit the first slide. As we go through the markets, if you have any questions about anything else, feel free to send them in through your questions on the website here or on the webinar here, and Michael and I will be looking at those as they come in, and then towards the end we will answer as many as we can, as many as time allows. So getting moving here, first slide. Okay, there's the what's that again, Michael?
You should be on the key points slide.
The next one would be the key point, yes.
I think it's just a little bit of delay coming up. Should be there now.
All right. So we're 1 month into summer. I know summer just hit this past weekend. The official summer solstice just hit this past weekend, but I go by the meteorological calendar, and so that starts June 1, starts summer. And so we're 1 month into the busiest quarter of the year, the key quarter of the year. Why? Because ag futures, and a lot of folks disagree with this, but honestly, I've been watching this long enough. Ag futures are weather derivatives. We've seen it time and time again. And if we've been watching the markets these last couple weeks in particular, we see it play out day after day, night session after night session. The weather forecasts, weather developments drive how ag futures move. And this is grains and oil seeds. This is softs. This even goes over into the livestock market. So anything in production agriculture, from cotton, cocoa, coffee, all of the grains and so on, they're all dependent on weather. We see the investment money come in on weather forecasts. Now, why is that important? Because investment traders set the trend of futures market. And that's one of the, again, a key point that we must keep in mind. Newton's first law of motion applied to market. A trending market will stay in that trend until acted upon by an outside force, and that outside force is usually non-commercial or investment activity. When I developed over the last 30 years my rules for markets, I have 7 rules for markets, and rule number 1 is don't get crossways with the trend. Why? Again, because the trend is set by investment traders. We may not agree with it. Let's take today's situation where the northern plains are bone dry. The U.S. northern plains and Canadian plains are bone dry, yet corn and soybeans continue to come down. We can look out our back window and say there's absolutely no reason for non-commercial traders to be selling, but they are. And we'll get into that here in a little bit. Non-commercial traders are selling, so we have downtrends. We must stay in step with those trends, whether or not we agree with it or not. Watson, my name for the computer-driven global investment side of the market, watches a lot of things. It watches momentum indicators, and I've talked to a lot of algorithm writers and fund managers over the years. They look at momentum indicators. They look at up-to-date weather and yield forecasting data. from private research company. And I've argued this for a long time. There's a lot of private data out there. And that's what the investment side is looking at. They're not looking at the made up USDA data. They're following the up to the minute, up to the second changes in weather forecasts, in yield forecasts. That's where they're getting their information. That's what they're plugging into their algorithms. And we can read that by watching the trend and by watching some other key factors in the market. And finally, another key point, Newsom's market rule number 6. I can say that non-commercial traders set the trend, and that is true. But in the end, when everything's said and done, that all the dust has settled, rule number 6, Newsom's market rule number 6, fundamentals win in the end. Eventually, these markets come back together. They come back to fundamentals. It doesn't matter, it doesn't, but in time, we will see the non-commercial traders tend to get back in line with what the fundamentals of the market is telling us. And so those are the key points. We must keep a close eye on non-commercial traders. We have to understand where the fundamental information that they're plugging into their algorithms is coming from, and eventually, ultimately, fundamentals win in the end. Okay, this past weekend, this is the sort of situation Michael and I have been around, and many of you as well, have been around these markets, not just for years, but for decades. And when I looked at my commodity view Sunday evening before the market opened, this is what I usually pull up, and this is what I usually post on the website. And it's the past 48-hour precipitation accumulation. And again, I pull this straight from commodity view. And when I see something like this, when I see a map this colorful across the US Midwest, parts of the Northern Plains, parts of the Southern Plains, and of course we have that huge storm system down in the far southeast, the first thought that crosses my mind is overnight session is going to see a lot of selling interest. That's a lot of rain. Now, it can be argued that places didn't get as much as maps show. That's always the case. But when this sort of data is fed into an algorithm and they can, quantify these colors any way they want to, and they see that Iowa's got some greens and reds and yellows and so on, some of the driest areas of the Midwest, this is a sell. This is a trigger for the investment side of the market, the non-commercial side, the algorithm side, whatever you want to call them. This is the trigger for them to sell. And that's exactly what we saw overnight, overnight Sunday, and it's continued through this week. So, we have a good precursor as to what should happen, and it has happened. As we'll get into, again, as I said a little earlier, we can see what the non-commercial traders are doing as it relates to the trends of the market. But this is what sets the tone. Anytime you come in on a Sunday evening and you look at what's happened over the course of the weekend when it comes to rain, particularly this time of year, the summer season, this is the type of results you're going to get a great deal of selling. Now, I say that, but has it changed the actual fundamentals of the market? And when I say fundamentals, what I'm talking about is, has it changed the production capabilities, the production possibilities of the markets? Here's where we have to dig a little bit deeper. And to do that, each week I post the National Weather Service Climate Prediction Center subsoil moisture maps. So many different yield forecasting and so on. This do not take soil moisture into account, and it is the key fundamental. It is the key weather outside of just rain, but this is the key of how effective is that rain being. And this was pulled after the weekend. This was for Monday, June 21st. And so what we see is we've seen rains across the Midwest. We've seen some rains across the Northern Plains. But look at the soil moisture deficits that are still in place. That huge, dark, almost brown, dark red, almost brown blotch just over most of Iowa, going up over Minnesota into the Dakotas, both north and south, across the upper Midwest of Michigan and Wisconsin, parts of northern Illinois and Indiana. These are some key growing areas. particularly this year after, the derecho hit, tore across the Midwest last August. That was changing, that changed the acreage ideas. The Dakotas, the acreage ideas were changed because of prices, because of the way the markets were moving last fall and into the winter. And now we see nothing but soil moisture deficits, and they continue to grow. They continue to get worse. And so it's changing the production possibility, the real production possibility. This is one of those cases where fundamentals will win in the end. We've got some selling going on right now. We've got some non-commercial pressure in the markets right now. But eventually, if these don't change, and if it continues to weigh on possible yield results late in summer, early spring, then we're going to see the markets eventually change directions again. Now, I mentioned the non-commercial side of the market, and we could pull these numbers straight from CFTC. I know they're also on the CommodityView system, but what I look at is, and this is the weekly, they come out every Friday, most Fridays, when there's not a holiday. These are the CFTC commitment to traders reports. And I like to look at, because I'm old, I like to look at the legacy futures only. This is the very basic. You look at the futures contracts, they break them down between non-commercial, commercial, and other. And you just look at their net futures position. In the case of corn, what we see at the blue line is that non-commercial position, the amount of long positions, the number of long positions, or ones they've bought, minus the ones they've sold, or the short position. And we see we had an incredible run. If we look at the non-commercial long, the green line, from about 200,000 contracts a year or so ago, almost exactly a year ago, up to more than 650,000 contracts long. The net position went from a minus 250,000 back in June of 2020, when the whole world seemed to be weighing on US grain markets. But it changed a year ago. Things changed a year ago. So what happened was we saw the non-commercial money start to not only cover their short positions, the red line, but also started to increase their long positions. And we went from a minus almost 250,000 contracts last June to as many as a plus 550,000 contracts. So a change of 800,000 contracts by the time we got into the spring of 2021. But since then, after some consolidation, this is a trend like anything else. We can watch the trend, which is simply direction over time. We could see that the non-commercial position is starting to come back down. The net futures position is starting to come back down. But it's not necessarily that this group, it's not necessarily that this group is adding short positions. So they're not selling as far as creating new short positions. Instead, they're just getting out of their previously owned long position. So why would they do that? It's raining. It's raining. We went from a dry situation this past winter and spring to starting to get a little bit of rain in late spring and early summer. It's still dry. We saw the soil moisture maps. It's still dry, but we've seen rains move across, and that's creating the sale of some of these long positions. So we've got the market coming down. We've got the non-commercial position coming down, and we have futures themselves. We've seen huge sell-offs in the futures market. It's a similar situation for soybeans, where we go back to 2 years ago, the summer of 2019, when the non-commercial net futures position, which again is the blue line, bottomed out at about 120, 125,000 contracts to the short side. And again, since then, a lot of what we've seen in this market, where it ratcheted up and eventually climbed to about a 285,000 long futures position this past fall, a lot of that was due. Here we see a lot of short covering again. The red line is the position went from a minus 265,000 up to less than 40,000, and adding some long futures positions along the way. Now, we've seen the non-commercial position stabilize and start to come down a little bit in soybeans. But the selling is, at face value, it doesn't look as aggressive in the soybean market. We're still sitting around a 200,000 futures contract long. It just hasn't been quite as aggressive from the high of 260,000 contracts on the net futures position down to about where we are now. So 50, 60,000 contracts. And the reason it hasn't been as aggressive is because, again, fundamentals win in the end, and we'll talk about that later. But we are seeing the overall picture start to change. We are seeing soybeans start to come down. Remember, it was a week or so ago that we saw July or November soybeans lose $1.20, $1.30 for the day. It was just an absolutely incredible meltdown. Again, it was tied to rain. Again, it was tied to panic selling. And we just saw these algorithms, the sell orders just start kicking in, and there was nothing underneath it. The market's recovered a bit, but it's starting to work back lower as these rain systems move across the Midwest. But there's a couple big differences that we'll get to in a little bit, and it all has to do with fundamentals. But if we go back to that soil moisture chart, the key is the Dakotas. I don't say this often, but the key is the Dakotas, the northern plains when it comes to soybeans, because North and South Dakota were expected to plant more acres than, say, the combined acres of the Dakotas was supposed to be more than the combined acres of Indiana and Ohio, as far as soybeans go. So that's why the soybean market, more so than the corn, is keeping a close eye on the Dakotas, on the dry soil moisture situation across the northern plains. And we haven't seen the aggressive liquidation in soybeans that we have in corn, at least to this point. Now, one of the great things, there's a number of them, and I can talk about it all day, with Barchart and Commodity View and Commodity Ag, is their national indexes for both price and basis. You can use them. They're the hammers and pliers of any toolbox. You can use them for almost just about everything. And what I use them for, one of the things I use them for, is to tell me exactly what supply and demand really is. And I'm not talking about, again, made up of make-believe world, supply and demand that comes in monthly USDA reports. I'm talking about real supply and demand. And we could tell this by looking at what the marketing year average is. In this case, what I'm looking at here for the Commodity National Corn Price Index over the course of the marketing year for corn, 2020-21 marketing year for corn, which is the gold dot, the solid gold dot. The speckled gold dot has to do more with USDA's projections, but the solid gold dot, that's where it's averaging 497 right now, and this was through mid-June. Now notice that is just above 2007, 2008, when stocks to use was around, well, I think it was like 10.2, 10.3%. And stocks to use is the key metric. Everybody always wants to talk about ending stocks. You can tell if someone actually knows what's going on in the markets if all they talk about is ending stocks. If that's what their focus is, kind of take it with a grain of salt, because the bottom line is stocks to use, and that's where you take ending stocks and you divide it by total demand. And the lower that number is, the more bullish the supply and demand situation is. The bigger it is, like if we were to slide off to the right-hand side where we see that jumble in the 12, 13% range, that's a more bearish situation. And notice, that's where we've been. 2016, 17, 18, 19, that's where the market was. That's what corn was dealing with for 4 years. Now, the interesting thing is if you look at all those arrows where the speckled dots are off to the right-hand side, that's where USDA's final estimates were versus what the Commodity National Corn Price Index was telling me at the end of each marketing year along the actual trend line. And so, based on the argument that the cash market is the intrinsic value of a market, of any market that we want to look at, the intrinsic value is the cash market. And so what the cash market's showing us was real stocks to use at the end of each marketing year. The conclusion is the previous 4 marketing years from 2016-17 through 2019-20 is that USDA, for whatever reason, was overestimating US corn stocks, and the cash market knew it. And eventually, as I said, fundamentals win in the end. And so what did we see once this all started to play out? We saw the non-commercial traders a year ago start to buy back into the corn market. And now we've pushed to 2021. The cash market is averaging 497. Last year it averages something like 341. So we're a good $1.50 above, just on the average, And we've cleared the previous 2007, 2008. I had to do a little work to find those. And we're talking about the only ones that are tighter than this marketing year is what we saw during the 3-year drought from 2010 through 2012, which brings USDA's latest projection into play, because what they're saying now, again, the gold speckled dot, what they're saying now correlates closer to the cash price averaging 693, to the commodity index averaging 693. We're $2 away from that. So now we have gone from official government reports overestimating corn stocks to underestimating corn stocks. And herein lies the problem. And herein is why we're continue to see some non-commercial selling, because if I can see this, and if I can point this out, funds can see it as well. Funds can see that, the investment traders can see, the investment community can see, we have more corn on hand than what USDA is reporting. And at some point, that will come back into the market. They will adjust their numbers to get closer to what the cash market is saying. Now, another way of reading fundamentals is by looking at the forward curve. I talk about forward curve all the time. And what a forward curve is it just looks at all of the prices laid out compared to each other. So, this one starts with the July contract to the SEP and so on, all the way out through December 2024. Now, what we see here is when you start in the upper left-hand corner and you go down to the lower right-hand corner, what you see is an inverted market. And an inverted market equals a bullish supply and demand situation. Now, I say that, but now let's look, if we just narrow this down into the DEES-21 contract out through the July 2022, there's a little upward slide. There's a little bit of an upward curve there, meaning that the deferred contracts have some carry built in. They're higher priced than the nearby contracts. This is still bullish, but it's not as bullish as if the market was inverted. So, we've still got a bullish supply and demand situation. But as we could see, and particularly when we start to compare it to the previous week, the week of June 14th, we're starting to see, some of these some of these carries grow a little bit stronger. But how strong does it take? How do we know? We've got an overall inverted market, but we've got some carry built in over the course of different marketing years. How do we know if it's bullish or bearish? Well, we can look at the cost of carry chart again on CommodityView. We plug in the numbers, and if we start over on the left-hand side, because September is that odd hybrid month where it's part old crop, part new crop, doesn't really know what role it plays in this game. So if we look at starting with the December contract, and at this one, it was priced at, when I pulled this, it was priced at 557. And we compare it to the March, May, and July, we see that there's a 7-cent carry out to March, a 11 cents carry out to May, and a 12-cent carry out to July. Now go down 2 lines, and you see like a 26.14%, a 24.64%, and then the 19.02%. That's the amount of calculated full commercial carry, the total cost of holding grain in storage, the whole total cost storage and interest for holding grain in a commercial storage facility. And if it's less than 33%, it's bullish. This goes back to my old merchandiser days when I broke things up into lower third, upper third, and center third was neutral. So if it's above 67%, 67% above, it's bearish. And the only market that we're seeing that in right now is hard red winter wheat, because we're in harvest. If we look out here at the corn forward, the cost of carry, we see a 19%. It has strengthened a little bit to 13.5, 14 as far as the carry goes, and it's pushed us out to like 21%, but it's still bullish. And it's going to take a lot of work to not be bullish because, again, if we go back to the slide that showed what the cash market's showing us, we have a very tight supply and demand situation. We have a very tight stocks to use situation, one that's only been topped by when we had an extreme drought in the United States. So we are dealing with tight supply and demand. It is carrying over into new crop. Traders, the commercial side of the market is still bullish, not as bullish as it was before because of the rains that we've seen, but the commercial side knows we're not out of the woods, and that could lead to some non-commercial buying down the road. Here's where it gets fun. Here's the soybean market. Same situation. Commodity National Soybean Price Index averaging through mid-June, $12.63. And if I take this out over time, that's telling me we have a 0.2% stocks to use. Absolutely incredible, incredibly tight situation, which is exactly why non-commercial traders have not been as aggressive in their selling, in their long liquidation as they have in corn. USDA still has it down around, 2.53%, something like that, their stocks to use. So we know they're way off. They're way overestimating right now, soybean stocks to use, which is exactly what it did in the 2013-14 marketing year. We see as the benchmark at the very high when my calculations using the Commodity National Soybean Basis or Price Index came in at 0.1%. So we're getting very close to that. And that year it averaged $13.18. We're getting close to that. And it wasn't until the September quarterly stocks report, September 30th, for stocks on hand as of September 1, the USDA ever took its number below 100 million bushels. We had an inverted future spreads. We had strong basis. We had everything telling us that it was a much tighter supply and demand situation, but it did not officially drop below 100 million bushels until the very end, the very last time the USDA could actually say anything about it. When everybody else was watching the new crop at that point, they dropped the old crop below 100 million bushels. So I think we're on that same path this year. I think USDA is overestimating soybean stocks. Here's a forward curve for soybeans. And again, what I talked about at the beginning, when I was talking about corn, starts in the upper left, goes to the upper right. We can see with the blue line below the dark blue, the lighter blue line below the darker blue line, we've seen a sell-off in the futures market itself, but it hasn't changed the inverse this much. You can take the inverse out through November 2024. We have a bullish long-term supply and demand situation that's not going to be solved with this harvest, and it may not be solved with the next harvest. It's that long lasting. And we started to see the early works of this going back to, again, the June 2019, but it really took off in the spring and summer of 2020 when Brazil and South America started to have some production problems, and the US started to get back into the global grain game. So I talked about the corn situation as far as having a slight carry. Now, just here the last couple of weeks, maybe a week or so, we've seen the Nov-Jan spread go into a small carry of about 4 cents. That was an interesting development, but if you take it out to the July contract, if you take that Nov-July, look at the whole forward curve, we were still sitting at a 7.5 cent inverse. All the red numbers, that shows an inverse. And there was a time when you couldn't find a green number on the soybean cost of carry chart. Now, it has changed. The rain has caused some change. And in fact, that Nov-July forward curve, that Nov-July spread is now sitting at about less than a 3 cent inverse after topping out at 56.25 cents inverse. So we've seen a lot of commercial selling, a lot of ideas that production here in the US could be better than expected. We could see more bushels this coming fall, but it's still up in the air. It's still bullish. That hasn't changed. And that's the key, is reading these markets. Now we know why non-commercial traders haven't been aggressive, because the fundamentals of soybeans are long-term more bullish than what we see in corn. Okay, so tying this all up in a few minutes here, so we turn it over to Michael. If we look at new crop corn, fundamentally the market remains bullish and should stay so over the course of the summer. I don't see that changing. This should keep support under the DS21 contract. Right now it's got a downside target of $5, popped below $5.20 today, and I think it was coming back above it late in the session. However, the major trend did turn down at the end of May, and this is a key factor, is that we saw a long-term trend change at the end of May, most notably by the Commodity National Corn Price Index. Again, the intrinsic value of the market posted a bearish reversal pattern in May on its May monthly chart, something that we're going to have to keep an eye on. So new crop soybeans, again, fundamentally, there's even less wiggle room in new crop beans than there is new crop corn. We have an extremely tight supply and demand situation coming out of the old crop. This could bring non-commercial buying back to the market over the course of the summer. Again, they haven't been overly aggressive selling, but they've been selling some. Technical support is near 1235 with a possible extension of this downtrend back to 1161. But the key, as always, will be the weather, particularly if the U.S. Northern Plains and Midwest continue to show worsening soil moisture deficit as the summer rolls along. Those are the keys. That's what I'm looking at. Again, I look forward to your questions at the end. There's a lot to talk about. With that, here's my final page. And again, you have all my information here, but we will have time for questions at the end. And with that, I'm going to turn it over to Michael.
Well, thanks very much, Darin. And we have had several questions come in, so hang in there, stand by, and we'll come back to you in just a few minutes. So just real quickly, wanted to cover Barchart a little bit. We provide solutions to agribusiness that help agribusinesses grow and drive results. I do want to just state, though, that that's just one of our segments. The CommodityView desktop, for example, is very, very well suited for other industries, certainly renewable fuels and food and beverage, and more so every day to the metals and energy space as well. So keep that in mind as we go through here. This is kind of directed towards that agribusiness market, but it is a broad range of solutions more generally. So it's, some of the pieces of this are the CommodityView trader desktop, so market information, news, weather, analytics. The marketplace app is our solution for producers that we brand and provide to elevators to provide to the producers, and we'll talk a lot more about that in just a few minutes. And then there's our more traditional space of content management. This can be cash bid management, so we have tools for elevators to manage their entire cash bid process, from developing those cash bids to publishing them out to websites and text and email alerts, and most recently pushing them out through the marketplace app as notifications. This entire suite of solutions is really powered by the content that we have available, connecting the different pieces of the workflow together, and connecting with partners as well. So on the content side, it's everything from global market data to news, fundamental data. We have just tons of commodity pricing network partners that provide us with their proprietary data. And that can be from grains to food ingredients to renewable fuels and carbon credits, and so on and so on. Then we also have our own proprietary data that we'll talk a bit about. From the connectivity standpoint, we have spent much of the last year integrating with all of the major ERP providers or grain accounting providers out there. You'd be hard pressed to find one that we have not integrated with or that we don't have in the immediate development queue currently. We also continue to onboard additional elevators, and I'll show you a little slide in a bit showing you kind of our reach and footprint into that whole agricultural space. And then a number of partner integrations, beyond ERP networks like hedge management systems and so on. From the workflow standpoint, our philosophy is to provide solutions that the customers want. So while all of the functionality that I'm going to talk about is available in our own software and platforms, we also expose all of that as APIs, so that if you're working with an ERP provider and you want to use their mobile app, we can enhance that mobile app with our offer management system, order routing, our chat mechanism to, negotiate and discuss offers and markets between producer and the merchandiser, and so on. Even our eSign capability can be embedded in partner applications. So we're not an all or nothing shop. We very much want to deliver the solutions that you need. And so we expose that functionality as APIs so that you can do that, so that you can use that same functionality within other applications. Commodity View is really the centerpiece of all of this. It's really the new standard for grain professionals, but as I mentioned, also many other commodity-centric businesses as well. But it really is a powerhouse. We've talked about it before on these webinars, so I won't spend a whole lot of focus on it here. But just trust me that it is the leading tool for grain merchandisers and others in the commodity space from the standpoint of the proprietary and global content that we provide to the tools, to the mobile applications and the Excel add-in. It is just a very, very comprehensive, powerful, and robust tool set across the board. The really cool thing is that it includes complete access to our global data. So we're not just a North American solution. We do have North American grain bids from 4,000 locations, but we also have international grain bids. For example, in Australia, we have some 2,500 data points every day that update. In Brazil, we just right now incorporating cash prices in Brazil. We have global CIF and FOB prices at all the major ports, import and export terminals around the world. So it is very, very comprehensive. And again, not just grains, but crude oil, retail and wholesale prices around refined fuels prices, even scrap metals. From a geospatial standpoint, Darin used a couple of maps earlier showing precipitation and soil moisture and things like that. All of that is available through Commodity View, and that was one of the questions that we had come in. Where are these charts available? Certainly, they're available from the sources as well, but we've incorporated all of that right within Commodity View, so you can pull these up and analyze those on a daily basis. That can be current weather conditions. It can be longer term things like soil moisture, growing degree days, heating degree days, land surface temps, even some of the satellite imagery that is used in most forecast and production modules or models like NDVI and NDWI. So tons and tons of information there within our maps, within Commodity View that you can pull up and see things just like Darin was showing you earlier. And then we also have access via Commodity View to our own proprietary forecast. So we take all of that raw data that we've talked about and we create our own yield and production forecast for North America, it's US and Canada, across corn, beans, and wheat. And just this year, we've launched South American yield and production forecasts, primarily Brazil and Argentina. So those now too are available. And then we have things like where we take our massive cash bid and basis database, and we create value-added data sets on top of that. That might be US basis forecasts. So we take the current basis, we apply seasonality to that and some other factors, and we make a prediction as to where those basis levels will be 4 to 12 months out at a time. And then we also use our cash bids to create our cash price indexes, which are volume weighted yield and production, or volume weighted price and basis numbers at the county level all the way on up to national. So the summary of that is it really is a powerhouse solution for that space. And again, connectivity is really key here. So the Commodity View desktop is not a standalone solution. It is part of a suite of solutions, and it connects directly to the marketplace app for the producers, which will be branded for the elevator. So from that marketplace app, for example, the producers are going to receive the elevator's full cash bid complement. So they'll see all the bids that are currently out there from their elevator. They can turn around and submit offers back to that elevator. They can pull their ERP information directly into the producer app. So their scale tickets, contracts, balances, settlements, all of that is made available between these various solutions. And I talked earlier about chat. So there's a chatting functionality within both CommodityView and Marketplace that allows a direct one-to-one communication between producers and merchandisers. And then when those deals are consummated, the merchandiser can eSign the contract on their side, push it out to the Marketplace app, and the producer can countersign that and send it back. Again, all through this complete solution. So if you're still pushing out paper contracts and trying to chase those down and get scanned copies back and all of that, this is a very good solution to streamline a lot of that contracting workflow. And elevators can provide the producers free access to that marketplace. So we provide it to the elevator provides it to the end producers. I've covered a lot of this already, but you can just kind of see how that all fits together. Some of the partners that we've integrated with in the ERP side are down at the bottom. So AgVance, AgTrax, AgVantage, Vertical, Cultura, Oakland, iRely, and beyond. And again, with more in the works like MTech and EFC systems. So a lot going on, and we continue to enhance this total ecosystem and network of partners, elevators, producers, all tied together into a workflow system and process. And you can see on the right-hand side, this is not a small endeavor. Barchart currently has 500 agribusinesses, which is a total of about 3,000 grain buying facilities that are powered by our applications and solutions. Okay, I want to just switch gears a little bit here. Promise I won't bore you, but I just want to show you two videos. One is around our ERP data integrations, and the other is our eSign application for Marketplace. So if you could just bear with me for a few more minutes, and then we'll go back to Darin. Okay, and here's the eSign. Okay, very good. Well, thank you for staying online and watching those videos. It's like I say, we spent a lot of time this past year integrating with all the ERP providers and developing the eSign capability. So, yeah, sorry about that. It wanted to keep playing. There you go. Problem with YouTube. uh, Yeah, so we spent a lot of time over the last year on ERP integrations and that eSign capability to really streamline that entire workflow process and communication between the producers and elevators. So I wanted to share those videos with you. They're available on our website along with many more that you're welcome to take a look at as well. So with that, we will jump over to questions and answers. And we have had several questions come in that we'll go through here. I'll bounce a couple off of Darin, and then there's a couple directed at Barchart as well. So Darin, here's a good one. I know that you'll appreciate in particular. The USDA numbers can be as far off as can be, but what do we do when ultimately those are the numbers that are traded?
And I appreciate the question. I really do. And I've heard it for 30 some years. And the reality is they're not traded. And I say that. I say that they are traded for a knee-jerk reaction, but it's not by the group that I talk about with Newton's first law of motion, with Newsom's first market rule. It's not the large non-commercial traders. It's not the algorithms. It's smaller traders. They, for some reason, want to trade. It's like a big Keno game, and you wait to see. I never understood Keno. You're given randomly some numbers, and then the group that gave you the numbers tells you if you won. And to me, it's always seemed similar to those that trade, the smaller traders that trade the USDA reports. If we really stop and think about it and take a step back, yes, we see these wild swings, for the first 5 minutes or so after the reports. More often than not, we settle right back to where we were before. The fundamentals didn't change. The spreads didn't change. The forward curves didn't change. Basis doesn't change. So the real fundamentals of the markets don't change. And as we could see in those non-commercial charts that I posted, they don't change that much based on reports either. Yes, we see spikes, and we can go back to the March 31st number. On that day, we did see both corn and soybeans post huge spikes, but there was a lot going on, and only some of it was tied to the quarterly stocks and progressive prospective plannings reports. By and large, month in, month out, there's not, real traders don't pay that much attention to USDA. They pay even less attention to the crop condition numbers released every Monday. In fact, I like to call those the Kardashians of USDA reports. Not only, so you can take that for what it is. They're the Kardashians of USDA reports. So you have some reports that are meaningless, and then you have some that are even less so. So yes, there is an immediate trade, but no, it does not change the long-term structure of the markets that we're dealing with, our long-term understandings of what is non-commercial traders doing and what does the commercial side think.
All right, that's great, Darin. Thank you. Another question: does the increased production in South America change the dynamics of the forward curve on beans? We have a harvest every 6 months that presses the market. How does that impact?
That's what makes this inverse that much more impressive. And the fact that, generally speaking, an inverse is solved with the next harvest. And as you pointed out correctly, I might add, we have a soybean harvest every 6 months. It goes from, Brazil to the United States, back and forth, the ebb and flow of supply and demand, but it didn't happen this time. Chinese demand, global demand, but we all know it's basically Chinese demand, is so strong that when the US was not in the global market, China basically drained Brazil of its available supplies. So then it turned to the United States, basically as a last gasp. It had to buy from the United States. And so it started to buy from the United States over the fall and spring, fall and winter. And so because of the shorter crop, tight supplies, huge demand for Brazilian supplies, over the course of the last few years, particularly the last couple of years, all of a sudden the focus was on the United States supplies, and those quickly got pulled down. And now we're dealing with a situation where Brazil had a big crop. We don't know how big, but we had a big crop. And it still isn't enough. It isn't enough to erase that inverse. Now, as we saw, we've seen some of the inverse come out of the market, but it's still inverted. And at the end of the day, an inverse in a storable commodity is bullish. I don't care what market we're talking about. I don't care if we're talking about crude oil. I don't care if we're talking about whatever storable commodity it is. If it's inverted, it's bullish. So fundamentally, soybeans are still bullish. The huge crops in South America, Brazil in particular, did not change it all that much. And now we wait and see what type of production the US has once we get through this summer and into fall.
Okay, excellent. Another one here. So overall grain market is an uptrend or just soybeans and corn alone?
Overall, and this is the real interesting thing, and it's just something I'm also a contributing writer or commentator for Barchart on their site, for CommodityView on their site. And the last piece that I just posted this morning talks about how, for so long, commodities have just been viewed as a, short-term, intermediate-term, casino sort of environment. But if we want to look long-term, and if we want to look at long-term trends and changes in the industry and the markets and so on, all of the major grains, corn, soybeans, hard red winter, soft red winter, hard red spring, the 5 major indexes posted, all established bearish reversal patterns on their monthly charts at the end of May. This tells us that the long-term trends now are actually down. Doesn't mean we're going to go down every day. Doesn't mean we're going to go down every week or every month, but we have topped out, at least the indexes, and my analysis of the indexes is telling us that we have topped out this bull run that we've been on for the last year or so. That's very important. It's a big change from what we've seen. So, we don't know the whys. Whys aren't important. That's rule number 5. It's not the why, it's the what. What's important. So we don't know why the trends are changing, but we do know the overall picture, since it's happening in the cash markets, the overall supply and demand picture may be changing as well. And it goes back to the previous question of maybe, we start to add in all of the South American production, the US production this coming fall, and maybe we start to lessen this. We start to take some of the pressure off this supply and demand situation that has built up over the last year.
All right, good. I think probably just one more question, Darin. And it's from somebody that was actually at our commodity exchange conference. It was 2 years ago, 2019.
Excellent.
In May. You were on a panel, a grain markets panel, along with Dan Bossie, Kent Beadle, and Alan Brugler. And at the time, you were all pretty much on the same page that, corn was stuck at that $3 level and soybeans at 5, 6, 7, wherever they were at. And you didn't see any obvious drivers that were going to change those dynamics for kind of the medium to long term. And here we are 2 years later with a very, very different market. Can you just kind of summarize, and you've already talked about a lot of this, but could you kind of just summarize what the heck happened over the last 2 years to get us back to, $12 or $13 soybeans and $7 corn?
Great question. That was a great panel. I really enjoyed being on that panel. A lot of good conversation on that panel. The biggest thing that happened, and we saw it in those non-commercial charts that I posted, and those were just for corn and soybeans, but we've seen similar in the wheat markets as well. But in corn and soybeans, we saw the money start to come back in. we saw investment money, global investment money, start pouring back in to corn and soybeans. And that, again, leads to a rally. But what was the underlying cause? Here over the last year, again, China had drained South America of most of its supplies. It had to come back to the United States. And all of a sudden, we started getting back into the global export-import game, global supply and demand game. And when that happened, it changed supply and demand. It started bringing in more money. Again, we were talking about 800,000 contracts change in just the corn market alone. So almost 1 million contracts went from short to long. So changes in overall global attitude towards the United States, changes in supply and demand due to weather. We've seen weather play a huge part in this, and investment money taking part of it. And that's the great thing about these markets. It's not like the stock market, rule number 7, stock markets go up over time. Commodities change direction, which is why this last May, the signals that we saw at the end of last May is so key, because we were getting those bullish signals a year or so ago on the same monthly charts. And now it looks like we're topping out. It means the situation's going to change. But going back 2 years ago, everything was bearish. We did not have the inverses. We did not have weak carries. We had stronger carries all the way around in all the markets. Fundamentally, the markets changed, weather changed, and the non-commercial money came pouring in.
Very good. Well, thank you, Darin. Very, very excellent and informative discussion. Really appreciate it. And really appreciate the attendance by the audience as well. We got a great turnout today. So, thank you for joining. Thank you for staying throughout the presentation. The analysis that Darin puts together, as he mentioned, he contributes to Barchart, and that some of that is available on CommodityView. But he also has subscription services available. So if you'd like to learn more about Darin Newsom analysis, his contact information is available there on the screen. And certainly, there's a lot of questions around what's available, within CommodityView, or where some of this analysis and charts and graphics available. They're available, through Barchart on our CommodityView platform. So my contact information is on the screen. Feel free to reach out to me or to your Barchart sales rep, and we'll help you out. With that, again, thank you, and everyone have a fantastic rest of the day.